The S&P and NASDAQ are sitting on double-digit gains for the year. Both hit new highs earlier today before pulling back. So can this record-setting rally continue, or are the markets set up for a second-half slump? Let's ask our Yardeni Research Chief Market Strategist, Eric Wallerstein. He's here, as you see, at Post 9. Welcome back.
Thanks, Scott.
So, I mean, Ed's been on a lot, okay, and he's obviously bullish. He gives us his bullish perspective when he comes on, but your target for the end of this year is still 5,400, right? You profess you're staying with that as well. That tells me you're a tinge negative for what's going to happen between now and the rest of the year. Is that right?
Yeah, I mean, with where valuations are, we had a top-line expectation of around 20 on the forward PE, and we're way past that at this point. So we might be getting a little more of a melt-up where we're getting valuations expanding as well as earnings, forward earnings rising. We think if the Fed cuts, that obviously becomes a much bigger problem. But we're staying with 5,400. We think sideways chop could be where we go through Q4.
So stocks are too rich. That's the bottom line. They've gone too far?
I wouldn't say too rich, and stocks can continue to get richer. But I think
in
at these levels,
multiple, it sounds like you're questioning the multiple at this level.
It could be a little ebullient, but I don't think that's a huge issue. And timing the market based on valuation tends to be a folly.
The Fed, you do not think that they should cut rates this year?
No, definitely not. I think the whole idea that as inflation falls closer to target, which it is, if you look at core PCE and you take out shelter, we're just below the Fed's 2% target. So we're getting there as long as measured rents continue to fall to where market rents are. But if you cut rates, you're risking inflation refueling. I'm not sure why you'd do that, and I think the experience last summer and in Q4 kind of gave them a little hesitation with doing that too early.
Well, if you don't cut, then you risk the economy rolling over. So what side of the coin do you want to play?
I guess the jobs market still looks good. Growth still looks good. If we look at jobless claims, we're below 250,000. Payrolls were great last month. We'll obviously get the next read on Friday in the following week. But I just don't see the weakness that requires you to cut.
You say that, and Ed, I think, has made this point too, that the Fed put, so to speak, is back. So even if you say that, the implication is that the Fed's going to come to the rescue no matter what. I mean, they're either going to cut because inflation comes down, or they're going to cut because they have to. And are you suggesting that under neither scenario is going to be good for stocks if they cut?
If they cut because inflation's falling, not because the labor market's unwinding, I think that'll help really fuel a big melt-up in the stock market, and valuations will expand even further. I mean, we could get to 6,000 on the S&P 500 if they start cutting when the labor market looks fine.
But I mean, they're telling you that they want to cut, and the market is still pricing in a couple of cuts.
The market was pricing in 7 cuts at the start of the year.
So you don't believe the market where it is now?
No. I mean, the market's the market. You just believe what they give you. That's what's being priced in. I think on balance, the market's saying, hey, they might cut. Maybe the labor market unwinds and they cut 4 times by 100 bips or 150 bips. That all kind of works itself into those median projections. But no, I don't think they need to cut. And they've already started rolling back QT. So the balance sheet policy is already starting to become easier. In some ways, they are easing a little bit.
What about the narrow market? What do we take from that as we make the turn here in the second half?
Yeah, I mean, this week, we saw a little bit of weakness in NVIDIA. We think there will be more rotation from the Magnificent 7 or Mega Cap 8 to the other 490-something constituents of the S&P, mostly as the market and companies figure out what to do with AI. Every company is going to benefit from this productivity boost, and if they don't, they're really going to lose out. So we'll start to see more rotation, I think.
I think there's a controversy about that, whether there's actually going to be a broadening. I mean, the economy is slowing. It is slowing. The consumer, some of the consumer data would suggest that the consumer's slowing too. If that's going to happen and there aren't going to be any rate cuts, as you don't think there are going to be, why is the broadening trade going to work?
So, I mean, does it really need to broaden anytime soon? The best analog is the 1990s, right? Info tech and communication services, we'll just call them tech, were around 41% of the index's market cap back then, but less than a quarter of the forward earnings. Today, they're around the same valuation, but they're a third of the forward earnings of the S&P. And a lot of these earnings are probably, granted they're forward, I think they're more realizable. NVIDIA is selling to Apple, Google. These are big companies that are going to survive. It's not like the 90s where you're seller financing and kind of relying on, not great demand.